Well, let's go to an expert to digest these numbers. Sal Guatieri is Director and Senior Economist at BMO Capital Markets, and he joins us right now. Sal, we'll thank you, first of all, for joining us today and providing instant insight into these numbers. We'll just remind viewers that headline inflation has come in at 2.7% in the month of April. That's down 2.9% from March and is exactly what the economists community had expected. Core inflation, or core median, as the Bank of Canada phrases it, comes in at 2.6%. That's down from 2.8% in the month of March, and less than the 2.7% expected from economists. What's your take, Sal, on these numbers?
Well, these are very good numbers for Canadians and for the Bank of Canada. So we saw the headline rate come down, but also the two key core measures of inflation that the Bank of Canada follows quite closely, median and the trim measure, both came down quite nicely. The trim now is below 3%, so that's fairly important. Apart from upward pressure in shelter, in the housing area, there's really not a whole lot of inflation now in Canada's economy. In fact, the CPI, excluding shelter, so big increases in rents and mortgage interest costs, that measure is only up 1.2% in the past year. So really good news on the inflation front for the fourth straight month now for Canada.
Sal, is it your belief that this data would give the Bank of Canada the confidence to cut rates on June 5th? And is there anything that could sort of, throw a loop in that view between now and June 5th?
It certainly weighs in favor of the Bank of Canada starting the easing cycle at its next meeting on June 5th, because this is now 4 straight months of pretty good core inflation numbers. Whether it meets the Bank of Canada's criteria of evidence of a sustained decline in core inflation, it's a close call. They might wait an extra month and move in July, but this report certainly moves the needle perhaps in favor of a June rate cut. As far as what could perhaps delay that move, well, we get another solid employment report, for example, showing another big increase in employment. And this time, if it tends to drive the unemployment rate lower, that might discourage the bank from moving. Certainly, if the wage measures in that report remain quite elevated, that could be an issue as well, because bank is not just looking at core inflation, it's also looking at signs in the labor market that inflation pressures are moderating. So even though a rise in the unemployment rate, not great news for workers, but it is good for the inflation outlook because it would suggest that wage pressures will start to moderate further.
How far away, Sal, chronologically, do you think Canada is from 2.0% inflation? We
believe we'll get to the 2% target by sometime next year. Middle of next year is probably when we'll see inflation get down. Again, it's really the pressure on the housing side, the shelter side, that's keeping inflation elevated, and that tends to be a slow-moving train. The rents, if anything, have been accelerating this year. It's the one item that's actually gone in the wrong direction, rising at an 8-9% annual rate. So that's been an issue. There's a lot of persistence there because rental markets are very tight. The rental vacancy rates are very, very low. And as well, of course, we just know that even if interest rates start coming down, mortgage service payments will continue to go up because so many more homeowners need to refinance their mortgage at clearly much higher rates than when they undertook those mortgages several years ago. So that's where the inflation pressure is right now. It's going to take a little longer to get all the way back to 2%, but the direction is certainly encouraging.
Sal, are you at all concerned that a rate cut by the Bank of Canada in June could sort of spur speculation in the housing market and drive housing prices up, and that might be a concern for the Bank of Canada, that that could sort of stoke inflation again if everyone's waiting on the sidelines for that first rate cut before jumping into the housing market here in Canada?
That's a big unknown, isn't it? I think we had a little more concern several months ago that once rate cuts began, the housing market would take off again, much like we saw early last year when there was just signs of or indications of a pause in the tightening cycle, and expectations the next move would be down. That didn't pan out. I think the concerns are less this time. I think the housing market in Canada is much better balanced. Yes, there is some pent-up demand. Many first-time buyers have been waiting for a while, waiting for interest rates to come down. I think there's also a lot of pent-up selling that could take place as well. We've seen a big run-up in home listings so far this year, and that might continue for much of this year, and sellers might be a little more eager to list their markets and sell once interest rates come down. So I think those two, demand and supply, will balance each other for much of this year. So we might see prices edge up a little bit later this year when rates come down, but we don't think we'll see a resurgence of home prices anytime soon. Affordability is just too poor in Ontario and British Columbia in particular for house prices to soar anytime soon.
Sal,